Now, Scott Kimball is a portfolio manager at Taplin Canida and Habacht, where he oversees $7 billion in assets. Scott, welcome. Now, you've got to tell us, you're beating the bond king this year. What is in your secret sauce?
Well, for starters, there's a couple distinctions you have to make. One thing is that the BMO TCH Corporate Income Fund is entirely focused on corporate bonds. And so far this year, we've seen a very large appetite for credit risk, specifically in U.S. corporations. So it's also a factor of making sure that we're talking apples to apples in terms of what's underneath both of our mutual funds.
Hey, well, you know, one of the issues is we have guys come on the show all the time saying, hey, it's all about yield. You don't find it right now in dividend stocks. You got to go to high yield. There's been a huge flow into high yield. So how much more can you have spreads tighten, and can you keep pushing that thing higher?
Well, realistically, if you go back to the comments that Ben Bernanke made earlier this week, he's very narrowly focused on the long-term trend to these major economic numbers, specifically unemployment in the housing market. So if you take him at his word, and we certainly do, he's going to do all he can to ensure that monetary policy stays very accommodative. He's been active across the yield curve, not just in the federal funds rate or the short-term interest rates. Therefore, if interest rates stay as low as they are now for another 2 or 3 years, you could still see a strong amount of flows into high yield and corporate bonds, which in reality could push spreads and yields quite a bit lower from here.
Well, within corporates, what are some names or sectors you really like here?
Well, it's more a question about profile. There's a number of sectors out there, obviously, that have attractive industry leaders in them. What we're really focusing on is corporations who have very strong cash flow profiles, who have seen their cash interest expense fall. As interest rates have fallen, these are companies that have refinanced their debt and have actually lowered their interest rate burden on their actual operating cash flows, which has allowed them to build liquidity on their balance sheet. The second thing we're also looking at is for companies who have also lowered their overall debt. If you look at a company's balance sheet, you know, with interest rates falling, 60 or 70% from where a lot of these initial interest rates were, it's quite possible that companies could have actually raised their debt and still seen a decrease in interest. So we like to see those two things in conjunction. We like to see, again, lower cash interest expense and lower overall debt.
Hey, Scott, that sounds pretty compelling. Can you give us a couple examples so viewers get a sense for the sorts of companies you're buying?
Yeah, I think a classic example to keep in mind is one that has what we call the problem of domicility. If you look outside the U.S. into Europe, we all know there's been lots of trepidation there, but you have companies there such as the Telecom Italia and Telefonica who are domiciled in Italy and Spain respectively, but their earnings actually come from 50 to 75% of their earnings come from outside of Europe. Therefore, you have an operating profile that's not entirely contingent upon the outcomes of Europe. And then you've also seen some very, very conservative financial policy. They've lowered their dividends, they've been paying down their debt, and they have access to capital markets through some renegotiated bank lines. So from our perspective, these are companies that offer very attractive spread and still have some room to go as far as future spread tightening or opportunistic ability to pick up some incremental yield.
How dependent are you on the new issue market? Obviously, we had a very big first quarter as far as new deals coming. We'll see what's to come in the second quarter. Do you need that new issuance to really fill your portfolio, or is there enough liquidity in the secondary markets?
We look at new issues with the new issue market with two different perspectives. Right now, dealer inventories are extremely low across Wall Street. Therefore, to get a nice amount of bonds for a mutual fund, or in our case, a company with $7 billion in dedicated fixed income, there is some reliance on the new issue market as far as finding opportunities. But even more important than that is the new issue market is indicative of healthy credit markets. So what we find is when we have a healthy new issue market and companies have access to our capital markets, not just in the U.S., but again, global corporations, that's a good sign for not only corporate bond spreads, but also for the health of our institutions, whether they be industrial, utility, or financials.
Well, that's all the time we have. Thanks to Scott Kimball, portfolio manager at Taplin Canida and Habacht.